You probably clicked on this video because you're wanting to learn about the stock market. Well, you came to the wrong place, but I'm still going to try to teach you about the stock market. The stock market is basically this place where you can buy a share of a company. You can buy literally a part of any company you want. You can buy a fractional part of any company you want, whatever. There's 100 different types of stocks. You have ETFs, you have mutual funds, you have blah, blah, blah. Okay, I'm going to teach you about the ones that matter, at least in my opinion. None of this is financial advice, but I'm going to teach you about the ones that matter and the ones that you should be buying and why you should be buying them and what the point even is in buying a stock or why you would even want to spend your money on something like a share in a company. Now this is a company you guys know, right? Apple. They make the iPhone, they make the Macs, they make everything. Now, you're probably looking at this and you're going, okay, it looks like a bunch of spikes on a graph. All that matters here, if you see, we're on 5 years. So this is a 5-year, this is showing how it has grown in the last 5 years. All that matters is that it says it has had a plus 100% return in the past 5 years. So whatever money you would have put into Apple 5 years ago would have went up plus 100%. Now you're probably sitting there going, well, so that means if I invest in any company, it's probably going to go up, right? Well, let me show you another example. This is AMC. I think everyone here knows what AMC is. It's the theater company. You go and watch your movies here, right? It has had a negative 93% return in the past 5 years. So whatever money you would have put into AMC, by now, if you would have kept it for the last 5 years, you would have lost 93% of whatever you put in. Now, you're probably thinking or have come to the conclusion that, like a lot of people do, stock market is just gambling. Whatever money you put in could go up or go down. What if I told you there's a way to make your odds significantly better, that there will always be a rise? Here we go. This is how you're going to start making money. This is called the S&P 500. You probably hear it on your news channels. You probably hear that random Republican on Fox News going, the S&P has dropped 2 points. The S&P has rose 2 points. What the S&P is it tracks America's top 500 companies. And it says, okay, these top 500 companies are either going up or they're going down. Most of the time, every year, they increase by 10%. That means no matter what, however much money you put into there is going to increase by 10% yearly, annually. Now, if you put your money in the bank, your money may rise 2%, 4% in a high interest yield or a high yield savings account. In the S&P 500, it is on average going to increase 10% yearly over a long enough span. Now, the thing is, you can't just throw your money into the S&P. You have to throw your money into an ETF that tracks the S&P 500. One of the most famous one is called VOO. If you get a brokerage app like Fidelity or Schwab, you literally just download the app, you set up the account that you want, which I'll talk about in a second, and you can throw your money straight into an ETF that tracks the S&P 500. And no matter what, you're going to be making some money because it's going to probably rise 10%. Now, this is not guaranteed, but the S&P has been pretty consistent. It has rose 10% yearly for a very long time, on average. So take that with a grain of salt. This is not financial advice, but I'm just saying, I promise you, I'm not lying. Look into it yourself. The point I'm trying to make is something called diversification. All these personal finance people are always telling you diversify. Most of us don't even know what that means. The S&P 500 is the definition of diversification, okay? Imagine having all of your eggs in one basket, which would be like putting all of your money into Apple. And then Apple has a bad year, or God forbid they go bankrupt, you just lost all your eggs. Now imagine if you invested in the top 500 companies in America. If all the top 500 companies in America go down, there's something a lot worse than losing a little bit of money or all of your money, because all of the companies in America are dying, so it doesn't really matter if you have money or not. The The point is, you are putting your money in the top 500 companies. There is an ETF where you can put your money in the top companies of the world. The entire world. You can literally put your money into the top companies in the entire world. So if the entire world goes down, your money probably doesn't mean shit anyways. And you've probably got bigger fish to fry. So trust when I say diversification is the way to go in the stock market. Now, there is some cons that come to that. Your growth is not going to be as fast as these finance gurus make you want to believe. Okay? They make you want to believe that it is a get-rich-quick scheme. The stock market is not that. It is more like a lose all your money in a day, if you look at it that way. Do not look at the stock market as a way to get rich quick, or anything for that matter. Look at it as a way to be smart with investing, because that is what it's used for. You can grow lots and lots and lots of money over time with compounding. So as that 10% rises every year, your money rises with that 10%. And every year, that 10% is getting higher and higher and higher and higher. Okay, so you've decided to start investing. You don't know where to go. You don't know what to do. I'll tell you, you start with a brokerage app. Okay, an app on your phone. I personally use Fidelity. I know about Charles Schwab. There's a couple others, Vanguard. You can look into them, see which one fits for you. I use Fidelity. You set up a Fidelity account, you link your bank to it, and you send money over. It takes probably 15 minutes to set up if you know all your information. You have a Fidelity account started. Now, there's a couple things when you're opening a Fidelity account, okay? It'll ask you if you want a taxable brokerage account, if you want a Roth IRA, a bunch of other stuff. I'm just going to talk about the ones that I use because that's all I have the knowledge on, okay? There's a regular taxable brokerage account. With this one, you can buy and sell stocks at will. You can put your money in, but every bit of profit you make is taxable. So it will count as a taxable income, whatever profit you make off this. So if you're planning on the long-term investment, there is something called a Roth IRA. Now, a Roth IRA is an individual retirement, something blah, blah, blah. Point is, it's for your retirement, okay? And it's made for you to be, as an individual, to start investing in. So I'll tell you the rules and conditions of a Roth IRA really quick, run you down through it. Roth IRA, you can only take your money out you can actually take anything that you put into your Roth IRA out anytime with no penalty or no fee because you contributed it. It's your money. But the profits that you make with that Roth IRA, if you decide to take out early, will have an income tax and a 10% penalty. So it's not worth it to take it out early. You can only take it out at 59.5. You can take out your contributions anytime you want. You're probably saying, well, this sounds like a huge screw either way. But when you take your money out at 59.5, there is no taxes at all. Another limitation with a Roth IRA is you can only put in $7,500 a year. So you can contribute $7,500 a year into your Roth IRA until the age of 59.5. And once you hit 59.5, you can take everything that is grown in that account, which would probably be in the millions if you max it out at $7,500 a year. A year. It would probably be in the millions, and you'd be a millionaire at 60 years old. Now, most people, like me in my 20s, hear that and they go, I don't want to be a millionaire in 60. Then I'm old and gross and wrinkly. Yeah, well, at least you have a plan set up for if you're 60 and, not dead yet. You'll be a millionaire, and you'll get to be on a yacht with your wife or husband or whatever. Okay, so that is just if you want to at least know for sure in your lifetime you will be rich. It's kind of like a plan B. That's what I see a Roth IRA as. And so I would suggest putting any extra money you have into your Roth IRA. It's a good way to invest. It is a good way to make sure that by the time you're 60, you will be rich. There is no ands, ifs, or buts. You will be rich. Anyway, that's the stock market. That's the basics of what you need to know. Start a Fidelity account and get into it. Start looking at other videos besides just this one. This one was really supposed to teach you the basics and to get more people into it. If you like videos like this, leave a comment. Tell me if you want me to talk about random stuff like this. I'm just kind of doing it for fun. Subscribe. like, do all the fun YouTube stuff. And yeah, that's it. That's all I was going to say. All right. Love you guys. Bye.